Welcome to Motley Fool Money. Thanks for being here. I'm your host, Chris Hill, and joining me in studio this week from Motley Fool Inside Value, Joe Magyer, from Motley Fool Income Investor, James Early, and from $1 Million Portfolio, Ron Gross. Good to see you guys.
How you doing,
Chris? We got a big show. We've got a big deal in the energy industry. We've got big layoffs on Wall Street, and we have got a consumer brand with big plans for the future. As I said, it's a big show.
It's a lot of pressure to live up to.
I think we're up to the task. We're going to start with the big macro, and that is the November jobs report. Here are the numbers, Ron. 146,000 new jobs added. That's against a forecast of 85,000, so better than expected. Unemployment fell to 7.7%. It's the lowest in 4 years. What do you think?
I hate to be a downer, but,
oh my gosh! I was trying to be excited.
I'm not impressed. I'm just not. It's better than expected, so I'll put that in the plus column. But the unemployment rate went down because another 350,000 people left the labor force, basically got tired of looking for a job and not getting one, and have exited the labor force. The labor participation rate is at 30-year lows. Unemployed people remained at around 12 million. It's better than losing jobs, where we're kind of getting on the right track, but it's nothing to be
percentage-wise. It is the lowest rate since the last time it was lower, right? I mean,
correctly, and that's a function of the fuzzy
4 or 5
math.
years, something like that.
The fuzzy math is what's doing it there. So I'm not impressed.
James, are you impressed?
Chris, I don't know enough to be impressed. It was a very dirty report. We had the hurricane. We had early Thanksgiving. We had, what else do we have? We have the election workers, fiscal cliff coming that might be causing employers to postpone. If anything, I'm a little bit more positive. I think there might be employers postponing hiring because they're worried about all the tax stuff. And then in January or later on next year, we'll see that.
That's a good point. One other thing in the plus column was that it appears that Hurricane Sandy really did not have a big impact, which is great to see. I've read some reports that think it might show up in next month's numbers. We'll have to see, but so far it looks like we kind of
I don't think this report is going to change anything the Fed or the market. I don't think this is like a mover of a report.
Yeah, that's fair.
Yeah, Joe, to Ron's point, we see revisions pretty much every month. Fair to say that there will be revisions with all of the X factors at work here, but what'd you make of the report?
I liked it. I mean, I hear Ron's point on labor force participation being low. That said, it was an expectations-beating growth number, and on the whole, I'm happy with that. When you look at that in conjunction with all the positive housing data we've seen, housing is going in the right direction on every metric that we follow. I think both those are very heartening pieces of data that portend well.
Yeah, I think the market popped on that, on kind of the headline. And then when people dug in a bit, the market started to trail off. We also got some bad consumer sentiment numbers, and that combined with digging a little deeper into the jobs report, and the market kind of gave away its gains.
Let's say, just for the sake of argument, that what America's economy wanted to do more than anything in the world was impress you, Ron. Is there a number? Is it if it drops to 7.5 or 7 or even lower than that, or is it that overall that U6 number that you're looking?
It just
to come
needs
down?
to get a Costco membership.
I don't have a basic number, but I would like to see people who want to work being able to go to work, so people re-entering the workforce, and then the unemployment rate slowly coming down over time as a result of the fact that companies are hiring and people are going back to work. That would make me very happy.
Get to work, America. Back in July, Netflix CEO Reed Hastings congratulated his employees about the fact that subscribers had watched 1 billion hours of video the previous month. Hastings did this in a message that he posted on Facebook. On Thursday of this week, the SEC notified Netflix it is considering taking action in what may be a violation of Reg FD. And Joe, that of course refers to regulation, fair disclosure, that public companies have to disclose material information, make it available to the public at large. What do you make of this story?
Well, we're for Reg FD here at The Fool. We were actually a big drive, and you could speak to this better than I could, but a big driver of having this pushed through for transparency for investors. It is a very complicated issue because we're moving into this realm now where where investors and companies and CEOs communicate in very different ways. You know, it's not just on a conference call anymore. And I think Hastings makes a very good point that he was sharing information in a public venue with 200,000 people who follow him. Now, you could say Facebook is maybe not public because you have to register to be in it. Mm-hmm. That said, is it any less public? Is that less public than a press release that goes out on their website? Now, you might say, well, of course it's public on a company, on a Netflix PR site, but practically speaking, 200,000 people are going to see this, including many reporters.
Yeah. All it has to be open to the public. So if I have a meeting I announce I'm going to announce some announcement, and people come to my meeting. That counts. No matter if, as long as the opportunity was made available. I think the rub issue is, was this known as an established channel for analysts to be receiving stock-specific information? I tend to side with Reed Hastings. I think the SEC is trying to look tough and stand up about this and set some sort of a precedent, but they're kind of picking on him as a way to do that. But that's the key issue. Do you go to Facebook to get investing information? I don't know.
Yeah, I was going to say, as SEC violations go, this is not a big deal to me, but I think it's kind of sloppy on Reed Hastings' part. I mean, if you've got news, like, stay off of Facebook. What is he? Let's keep all CEOs off of Facebook for a while.
He wasn't. I think he was just letting it slip, right? He wasn't actually trying to make that the way he disseminated the news. Is that correct?
Well, they had blogged about it earlier and said they were approaching kind of that number. So I don't think he felt he was really giving away anything that was earth-shattering. And he's probably right, but I just think it's kind of sloppy.
But at its core, this question, whether we're talking about Netflix or anyone else, the question on the table is posting on Facebook, does that count as adequate fair disclosure? And the SEC appears to be saying, no, it doesn't.
Well, I suppose it depends. I mean, if I post something and it only goes out to just my friends and family, and that's, I'm friends with, 200 people on Facebook, then no, I'd say that's probably not. But if I'm a public figure with 200,000 followers, that's a different story.
And the SEC, if you have material new information and you release it in the press release, you're also supposed to file a Form 8K with the SEC disclosing that you have disclosed something new. And that, if you don't do that, then the SEC says, well, you failed to meet a disclosure requirement.
Would disclosure on Motley Fool Money count as public? Do we have enough?
I don't know if we have enough listeners for that. This news involving the SEC overshadowed what was previously a pretty good week for Netflix, because earlier in the week they announced the deal with Disney that Netflix is going to pay Disney for first-run rights to Disney films starting in 2016. Shares of Netflix are up overall this week, even when you factor in the SEC stuff, Joe. But what do you make of the Disney deal? Because they're paying a lot of money, but it is really the first time we've seen a major studio make this kind of deal with Netflix as opposed to HBO or Showtime.
Yeah, I think this is a big win for them. It's an end around the traditional model, and they're going to have not original, but new, fresh content coming on that people really do care about and want to see quickly. It's going to be a differentiator, and it's 3 or 4 years out, and I know people say, well, it's not going to help them until then, but they're also not going to be paying for it until then, and it gives them a chance to kind of grow into the cost that it's going to be. It's going to be expensive, and I wouldn't be surprised if between now and then you see them change their cost structure, or change their pricing, I should say, maybe come up with tiered pricing for different strategies, different content feeds, but ultimately I think this is a good move for them, and look, I mean, this is what the business is. It's about getting great content on there and exciting people. And if they're not going to take shots downfield, getting great content, then what are they doing?
But the deal is estimated to cost $300 million a year, which is, I think, more than their entire net income, right? So isn't that kind of
I'm not saying they're in great
that
shape,
they have to clear?
But I do think, I think this will also bring more customers to them.
So
go ahead.
I was just going to say, does this deal make Netflix stronger as a standalone company? Does it make them more valuable as a takeout candidate, or both?
Yeah, content is king in this business model, and if we were going to criticize them when they lost the Stars account, and which was mostly Disney content, a lot of Disney content, I should say, I think we have to give it to them by getting this deal done and getting Disney content back. I think it makes the company stronger. I think it makes it more appealing to potential acquirers. I know even this week Apple has been bandied about in the media as potentially being interested. I've always thought Netflix eventually gets acquired and it isn't a standalone business. It needs somebody's strong balance sheet to pay $300 million a year for this is just one deal, let's remember. So eventually I think it becomes part of a bigger company.
Shares of Citigroup up more than 7% this week after announcing the company is cutting 11,000 jobs. James, more than half of those are coming in the consumer banking division. What do you think?
Well, and they're even leaving Pakistan altogether, Chris.
I didn't know that was a big part of it.
And I've spent some time
there
in
goes
Pakistan,
my
actually,
thesis.
at Malta. Citigroup has long been kind of the sick man of American banking, and they were really bloated. When you're too bloated, you have to unbloat, right? All the banks were basically staffed for the heyday of 20+% returns on equity, so those are gone. So they have to unstaff. This is 11,000 people now. I think they've cut, I read, maybe 100,000 or something like that over the past 5 years. So it's been a gradual process. The question is this enough, or are they actually going to have to break up Citigroup? I've always been a fan of breaking up the big banks. We'll see.
When you look at some of the other big banks, Bank of America, J.P. Morgan in particular, their stocks rose in concert with Citigroup's, even though they weren't announcing these kind of major job cuts. Do you think other big banks are looking at Citi and saying, you know what, we need to do an even better job of unbloating, to use your word?
Well, I read in the Wall Street Journal, Chris, that some have cut. Goldman cut 20 jobs and Barclays cut 50. Not much, right? But I think it's kind of a joke. I think that could be a precursor to something, but who knows?
Yeah, all these guys have cut headcounts, and I think you're going to see a lot more of that. I think B of A especially has a lot more room to wring people out of the towel, and that's unfortunate, but it's definitely going to happen. They're going to reduce headcount substantially over the next 2-3 years.
If you think there are enough Starbucks locations in the world, we have got some really, really bad news. Stay right here. This is Motley Fool Money. As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. Welcome back to Motley Fool Money. Chris Hill here in studio with Joe Magyer, James Early, and Ron Gross. Big deal in the energy industry this week, guys. Freeport-McMoRan Copper and Gold announced it is buying Plains Exploration and Production and McMoRan Exploration for a total of $9 billion in cash and stock. And Joe, we got a mining company buying oil E&Ps.
It all makes sense.
This is diversification at its best, isn't it?
Yeah, this was terrible. So Freeport stock fell about 15% that day, and I think that's totally justified. Look, if you bought Freeport-McMoRan, it's because it was a play on copper, and they went out and bought some assets that have nothing to do with that. Traditionally with a merger, you can wring out value. It's horizontal or it's vertical. If it's vertical, you're doing something like Apple buying a component supplier. If it's horizontal, it's maybe two different carpet companies coming together to wring out synergy. This is a total case of diversification where there's no value in adding the oil assets to this business. Management doesn't have a unique expertise in oil and gas. Very, very upset. I mean, if I was a Freeport shareholder, I'd be checking out.
James?
Maybe this is a thinly intellectual point, but nobody else thinks it's weird that a company called Freeport-McMoRan is just now buying McMoRan.
Okay,
isn't like someone with a hyphenated last name like finally marrying the guy
in 1994.
Yeah, they used to have it.
Right, they spun it off in 94, and what makes this worse is that the executives at the top of the companies are basically at the top of both companies. So there's some back and forth between the CEOs and the board. So there's not really an independent perspective on this, and they did set up independent panels with the board and whatnot, but I mean, give me a break.
Joe, how about if I retorted, though, and said that copper is very economically sensitive, so this gives them some maybe positive diversification. Many of the other big resource companies, BHP, who else, they Rio Tinto, they're somewhat more diversified. So this sort of helps them. Is that true?
Well, at the company level, but the thing is, with commissions, $10 in the market, I don't need my companies to go out and diversify for me. I can do that on my own, and I'd rather have a basket of pure play
stocks. But we're talking about their needs, Joe, not yours.
Well,
these are the managers.
That is true. The managers are definitely better off with this deal.
Starbucks announced this week it plans to open 3,000 new stores in the Americas over the next 5 years. That's a pretty big number. Ron, what do you think of this?
I like it. I think Starbucks is doing a really good job. Lots of avenues for growth. This will increase their store count by 20% over the next 5 years. Then they've got the Tivana, they've got the Evolution juices, the Verismo coffees, the packaged goods business. Lots of avenues for growth, which they better have because the stock's not that cheap, and they've got to grow into their 30 times PE. But as long as they execute, which is the key to obviously any well-run business, I think they've got a lot of great growth avenues.
Where are they going to put the Starbucks? I mean, inside other Starbuckses? I mean, is there any more land left?
Yes, they will. They'll be mostly in the Americas, more than half in the Americas. But they're actually going to go big into China. China will end up being their China will overtake Canada as the number 2 market. So some interesting growth opportunities there.
And Mars.
Mars, of course. I guess my only concern here as a longtime shareholder is you mentioned Tivana Holdings. I would also throw out the acquisition of La Boulange, the bakery chain. I'm just concerned that this type of growth or attempted growth will undercut their ability to integrate those other things.
definitely an execution story, and they've spent a lot of money, maybe $1 billion or so, including Tivana, on acquisitions recently. So they've got to integrate those successfully, not take their eye off the ball, don't ruin the core business. But the balance sheet's still strong: $2 billion in cash, $500 million in debt. Stock's up 16% this year. Things are going well for Starbucks.
All right, let's move on to the stocks that are on our radar this week, and we'll bring in our man Steve from the other side of the glass with a quick question for you. Ron, you're up first.
Deckers Outdoor, ticker symbol DECK, footwear company primarily known for its Uggs brand. Stock is down 60% from its 52-week high, has bounced back off its low, but the company has been struggling with some weak sales, higher raw material costs. Stock looks really cheap, could be an interesting value play.
Steve, I know you're a fan of Uggs. Question for Ron?
Ron, do you own a pair of Uggs?
No, but my daughter owns several, so we're good. Thank you for asking.
James?
Chris, I'm going with a company called Bob Evans. The ticker is BOBE. This is a greasy spoon restaurant, the kind of place you don't take anyone to impress on a date. In 2003, after a week-long backpacking trip, I went to a Bob Evans and ate a whole Bob Evans pie because it was the only place that was open. And I have not really thought about this company because of that since then, but it's getting some media play because they're going to sell off an underperforming business called Mimi's Cafe. An analyst upgraded them because of that. So it's a tough business, but it pays a 2.8% yield. I'm taking a look at it. It's just on my radar.
What is the ticker symbol?
BOBE.
Steve?
How many areas is Bob Evans actually in? I know they produce meat, don't they? And they've got restaurants.
Yeah, they sell some of their items. It's mostly a restaurant business. That's the mainstay.
So what did you eat there? Because
what kind of pie?
I think of Bob Evans as a place that you would
pie. It is a place I would normally never go to, but when you're desperate, there was nothing else open. So I went there and they didn't have much. Maybe they were closing or something. So I got a pie. That's what they had. So I got a pie and I drove in my car eating the pie. I ate the entire pie and I felt sick. And that's what I think about when I think of Bob Evans.
That sounds like a wonderful business.
Yeah, awesome.
Joe Magyer, your stock?
eBay. I know I've pushed this stock on the show plenty of times before, but they had a killer holiday season.
What's one more time?
Right, pile on.
Sure. The marketplace business had an outstanding November. So eBay.com, according to Channel Advisor, which tracks this, saw same-store sales up 27% November. It was 18% last November. That's a really impressive acceleration. I don't think the market's paying attention to that. PayPal is still growing at about 30% a year, and the GSI acquisition is now just looking brilliant. Balance sheet's in very good shape. Stock's not expensive. Very nice.
Steve Broido?
How many man hours do you think are wasted on people bidding, listing things on eBay for insane prices, and no one buys them, and the auction's over, and no one wins it, and it just seems like a giant waste of everybody's time.
Sounds so emotional.
Wow.
Sounds like Steve got burned.
Well, it's not pie, but the auction business is actually falling about 20% year over year, but fixed price sales are growing almost 40%. So fixed price is definitely where it's headed.
All right.
No more wasted time.
And it's people hours, not man hours.
Thank you.
Ron Gross, James Early, Joe Magyer, guys, thanks for being here.
Thank you, Chris.